Welcome to The Explainer. Today we're tackling a concept that really separates the flashes in the pan from the seasoned professionals in the financial markets. Look, whether you're an active trader just trying to survive a crazy 20% overnight Bitcoin flash crash, or a long-term investor building a multi-decade wealth portfolio, protecting your capital is the absolute, unquestionable first step. Today, we're going to bridge these two worlds, active trading tactics and long-term wealth management, to show you exactly why survival must always come before profitability. All right, let's dive right in. 50%. Let's just start right there. In the financial markets, the math of loss is incredibly unforgiving, and this single number is the exact reason why. A 50% loss requires a 100% gain just to break even. Seriously, let that sink in for a second. If you aggressively risk your account on a volatile Bitcoin swing and suffer a 50% drawdown, well, a 50% gain the next day doesn't save you. You need a massive 100% gain just to get back to zero. This is the ultimate reality check, right? Rebuilding lost capital requires exponentially more effort than just protecting it in the first place. The incredible power of compounding really only works once your initial capital is relentlessly protected. So let's establish a shared baseline here. Capital preservation is the active practice of protecting trading accounts or investment portfolios from large losses to survive market volatility and avoid losing purchasing power. Now, the absolute most crucial word in that definition is active. Capital preservation isn't just passively sitting in cash, especially with inflation quietly eating away your purchasing power over time. It's actually the highly deliberate, active foundation of compounding your wealth. Here's our roadmap for today. The reality of drawdowns, principles for active traders, tracking your trading edge, rethinking the traditional portfolio, alternative assets for defense, and finally, consistency over aggression. Let's kick things off with Section 1, the reality of drawdowns. Look, every single strategy, no matter how meticulously researched or flawlessly executed, goes through losing periods. Picture your trading chart for a moment. A series of small red candles, that's totally fine. It's just a normal cost of doing business. But a massive, account-draining red candle, that causes permanent damage. Your primary objective during a drawdown isn't to force a quick recovery. This is exactly why professionals implement strict daily and weekly loss limits. When market conditions become unclear, they step back, reduce their trading frequency, tighten their risk control, and prioritize account survival above literally everything else. Moving into Section 2. Principles for active traders. So how do participants in highly volatile markets actually implement these survival tactics day to day? Well, GoTrade outlines a really solid step-by-step capital preservation plan. First, define your risk beforehand. Know exactly where your stop loss is before you even enter. Second, risk a small fixed percentage per trade, completely avoiding over-leveraging. If you're trading something like a gold futures contract, unpredictable leverage spikes can absolutely wipe you out. Third, trade only high-probability setups and reduce your position size during uncertainty. Scaling down isn't a weakness, you guys. It's a vital risk adjustment. And finally, gracefully accept missed trade. Preserving your buying power for future clear setups is always better than forcing a bad entry. On to Section 3, tracking your trading edge. Because principles are great in theory, but they have to be measured in practice, right? Tracking your edge is how you eliminate that dreaded emotional revenge trading. The Trade Review app provides a streamlined process to log or import your trades directly from your broker. By importing your setups, you can objectively look at the data, like specific candlestick patterns or technical indicators, and honestly answer yourself, did I actually follow my capital preservation plan today, or did I break my own rules? Data is the ultimate truth teller. By tracking your win rate, your profit and loss, and your expectancy, you can completely analyze your trading behavior. Case studies of successful traders almost always show a smooth, steadily rising equity curve with shallow drawdowns. It's the total opposite of the erratic, jagged charts you see from aggressive gamblers. Journaling identifies exactly which market conditions drive your edge and which ones drain your capital, ultimately keeping you in the game long enough to actually profit. Section 4. Rethinking the traditional portfolio. Zooming out from the micro level of daily trading charts to the macro principles of long-term wealth building, we really have to look at institutional portfolios. For decades, the gold standard for preserving long-term wealth was the 60-40 portfolio, 60% stocks, 40% bonds. But according to KKR's macroeconomic data, this traditional model is losing its effectiveness. Why? Higher inflation and rising stock-bond correlations. Take 2022, for example, a brutal year where both stocks and bonds plummeted simultaneously, leaving the traditional 60-40 model completely exposed and resulting in negative real returns. The solution is a more modernized framework. Based on that same data from KKR, we can see that while a traditional 60-40 portfolio suffers an 11.6% volatility rate, an updated capital preservation framework drops that volatility all the way down to 8.5%. This active, modernized approach defends against drawdowns significantly better, proving that preserving capital today requires way more than just holding government bonds and crossing your fingers. Which brings us to Section 5, Alternative Assets for Defense. So if bonds aren't enough on their own to protect our purchasing power, what else should be in the mix? Instead of relying purely on public bonds, KKR's capital preservation model diversifies heavily into private markets. By allocating strategic chunks into private credit, infrastructure, private equity, and real estate, this structure is specifically designed to manage risk and act as a powerful defense mechanism for wealth against inflation. Synthesizing insights from both KKR and Equiris, we can unpack exactly why these assets work defensively. Private credit often utilizes floating interest rates, which act as a natural hedge when inflation rises. Infrastructure involves essential assets. We're talking the power grid or water utilities, things that people pay for no matter what the stock market is doing, providing highly stable cash flows. And defensive stocks, specifically in sectors like healthcare and consumer staples, see steady demand even during geopolitical unrest. These assets provide a crucial, tangible cushion when global markets get rocky. All right, our final section, consistency over aggression. Compare the aggressive mindset to the consistent mindset. The aggressive trader chases missed trades, overleverages, and forces entries. This is the trader who takes a heavy hit on Bitcoin, panics, and immediately doubles their leverage to try and win it back, which, let's be real, almost always results in a blown account. Over in the consistent camp, the priority is maintaining stable risk per trade, calmly accepting missed opportunities, and prioritizing surviving drawdowns. Realize that sometimes simply not losing money is a highly successful day in the markets. Whether you're a day trader or a long-term investor, consistency, discipline, and patience will always outlast aggression. Which brings us to our final thought. I want you to ask yourself right now, is your main focus currently growing capital or protecting the capital you already have? It's a really crucial distinction because, as we've explored today, the absolute prerequisite for sustainable growth is an ironclad defense. Take a moment to reflect on your own financial strategy. Thanks so much for joining me for this explainer, and I will see you in the next one.